Welcome back to another episode of the MD Investor, the channel where we talk personal finance. We're continuing today in our series of building a dividend portfolio. Yes, we're continuing in building a dividend portfolio because one thing that we all are trying to achieve is financial independence, and part of that process is getting a stream of passive income that we don't have to work for. If you haven't checked out part one, basically about building a dividend income. So now this is going to be part two about building a dividend portfolio. Some things that we need to consider. All right. So building a passive income, something that we want to consider. One of the things we're going to want to consider is this company making money? Right? Seems like a no-brainer, but we got to mention it. Is this company making money? So here I'm on the investor relations page of McDonald's, right? I figure I'll choose McDonald's, very popular company, right? So you can go into any of these publicly traded companies and you can go to the investor relations page and you can get what's called the 10Q, which is a quarterly report, and you can look at all the financials. They also have an annual report called a 10K, where they do the whole thing for the year. So this is McDonald's, and it is the first half of 2023, right? Ending June 30th. So again, first thing you want to consider is this company profitable? And the way we know if this company is profitable is by looking into the financials. Okay, so here we have revenues. This is all the money coming in to the company. All the money coming into McDonald's. So we have total revenues of $12.4 billion. It tells you dollars and shares are in millions. Everything is in millions except for the per share data. Okay? So this would be $12,395 million or 12,395 million, or 12.4 billion dollars. That's all the revenues coming in to McDonald's from all the Big Macs and all the fries and the shakes and all that stuff in the first half of 2023. $12.4 billion. Then this is the breakdown, right? 4.7 billion coming from restaurants operated by the company, and then 7.5 billion coming from restaurants operated by franchise or franchisees, and then this is other revenues. What you want to do also is compare that to the previous period. So the first half of 2022, which is the year before, the total revenues of 11.3 billion. So increase of about $1 billion year over year. That's something you want to look into, right? This company is making money. So that's the revenue, right? Now let's look at the expenses. See, the expenses down here are about, for the first half of the year, $6.7 billion, right? So about maybe a little more than half. $6.7 billion is the expenses. And then you take the total revenues, 12.4 billion, minus the total expenses, 6.7 billion, and we get an operating income of about $5.6 billion. And that is increased year over year, right? The first half of 2022, it was 4 billion. So operating income had increased. You are happy to see that, right? You want to see that. So that's great so far. So profitability. Is this company making money? And from looking and doing our little superficial research, we see that McDonald's is making money. That's why people are in business. They're making money, right? And year over year, it is increased, right? We see the operating income is increased. Sometimes now you'll see what they call earnings per share, right? Because like I said, one thing these companies do is they chart everything. So you see operating income of $5.6 billion. And down here is the number of outstanding shares. So there's about 700, remember everything's in millions, 734.9 million shares of McDonald's stocks outstanding, or 734,900,000 of outstanding McDonald's shares. To find the EPS or the earnings per share, you'll take the operating income, which is basically the earnings, $5,636,500,000. You divide that by 734,900,000, and you'd get earnings per share or EPS, earnings per share of $5.60. Okay? This is all the math we need. We need to know. We don't need any algebra or anything like that. We don't need any fancy calculus. So you take the operating income, you divide it by the number of shares, and you get your earnings per share. $5.60 in earnings or profit for the first half of 2023. All right. Now, if you want to, so that's great. Now, the other thing you want to look at too when you're evaluating a dividend paying company is the dividend payout, right? How much are they paying in dividends, right? The exact number. McDonald's is paying $1.52 per quarter, right? And they're paying that 4 times a year. It's four quarters in a year. So McDonald's is paying $1.52 every quarter. So if you do 2 quarters, right? Because this earnings per share is for 2 quarters, right? First half of the year, 2 quarters. $1.52 times 2 would be $3.04. So McDonald's is paying out $3.04 in dividends. Now let's just do this right here real quick. So $1.52 times 2 is $3.04. And we take the $3.04 and you divide that by $5.60. That's the total earnings you're making in that same time period, times 100. And we get 54.28%. I don't know if you can see that. 54.28%. And you may be asking, what is this 54.28%? That means McDonald's is paying 54% of their earnings out as a dividend. They call that the dividend payout ratio. That's something you look at too when you're evaluating a dividend stocks. That means if they're paying out 54% of their earnings as a dividend, they are retaining about 46% of the earnings in the company to grow the company, to invest back into the business, to maybe buy other businesses, right? But you don't want to give out all your earnings as a dividend because there's nothing left back in case something happens, right? So what's a good dividend payout ratio? A good dividend payout ratio, I would say less than 60%, I would say. Less than 60% is a good dividend payout ratio. That means they were keeping enough money back to grow the business. There's some industries where the company historically will pay at a higher payout ratio, such as the utilities. The utilities notoriously pay a higher percentage of their dividends, right? Because they're very high. It's a very high capital expenditure business, right? Lots of materials, a lot of capital expenditure. So you'll see 75, 80% if you're buying a utility company. Okay, so let's keep that in mind. Okay, so another thing too you'll see, and we just mentioned, is EPS. You'll see EPS, and you might be wondering what does it mean. Now you know it's basically just the earnings per share. They took all the earnings, right? They took all the revenue, subtracted from. They took all the revenue, take away the expenses, and you have your net income or your earnings, and you divide it by the total number of shares outstanding. One way, one of the way you'll hear companies return value to shareholders is when you'll hear them talk about buybacks or share buybacks. So in this example, McDonald's had 734, almost 735 million shares outstanding. If McDonald's Corporation buys back some of their own shares, that will remove those shares off the market, and there'll be less shares available. The earnings remain the same, but there'll be less shares, which means each share now becomes more valuable. That's how sometimes companies will return value back to shareholders by doing a buyback. You'll hear them talk about they're doing aggressive buyback. They're buying back $10 billion worth of stocks, which means the remaining or outstanding shares become more expensive, which is great as a shareholder. Now, we're going to leave my computer and talk about a few other things. I'll see you in a moment. Okay, so let's continue. The other thing you want to consider when evaluating a dividend paying stock is how expensive is this stock? It sometimes can be confusing. One stock is $400 per share and another stock is $100 per share. Surely the stock that's $100 per share is cheaper, but that's not exactly how it works. Now, if I told you that David got 20 questions correct on his math exam, and Jessica got 80 questions correct on her math exam, who got the higher score? You wouldn't be able to make that decision, because if David got 20 questions correct on his math exam, but there were 20 questions in the exam, so he got everything correct. 20 out of 20. He got 100%. Jessica got 80 questions right. 80 is more than 20, but she had 100 questions on her exam. She got 80 over 100. She got 80%. David did better than Jessica because he got 100%, even though it was 20 questions, but he got all 20 right. She had more questions right, 80, but it was out of 100, so she only got 80%. So it's almost like that. Now, to decide whether one stock is more expensive than another, we have to use a ratio called PE ratio. It is basically the price to earnings ratio. Sometimes they'll refer to it as the PE multiple, right? And it's not a difficult thing. Sometimes things seems more difficult or more complicated when you don't know what it is. The PE multiple or the PE ratio is basically the price of the stock, P, the price of the stock, and E is the earnings. Okay? PE, right? So the PE ratio or the PE multiple is basically the price of the stock, which is P, over earnings per share. That's what it is. We just went over EPS, right? Earnings per share. We just went over that, right? Which is all of the revenue minus the expenses will give you the net income or the earnings. You divide it by the number of shares outstanding. That gives you the EPS. So the PE multiple is just basically going to be the price of the share, the price that this stock is trading at, and you divide that by earnings per share. Let's use McDonald's, for example, that we use while we're in the computer. The price of one share of McDonald's is about $250. And the EPS, or the earnings per share, right? We said it was about $5.60 for the first half of the year. So let's just double that, and we say it's going to be about maybe, say, $11. Say $11. So the PE multiple of McDonald's is going to be, the price is going to be $250, which is the price for one share currently, and the earnings per share is about $11. So 250 divided by 11, and that gives us, it's going to be 22 point something, almost 23. So the PE ratio for McDonald's is somewhere about 23, maybe a little less than 23. Now the next question is, what does that mean? Is that fair value? Is that overvalued? Or is that undervalued? And again, these are terms you're going to hear when people talk about the stock market. Fair value, overvalued, or undervalued. Now, fair value would be like you're getting really for what you're paying for. Because the PE ratio basically is how much are you paying for $1 of earnings for the company, right? So in McDonald's case, you're paying $23 for $1 worth of earnings for the company. And I would say that is slightly rich or expensive. Now, the numbers they use are anywhere from less than 9 would be considered you're getting a deep discount, you're getting value. 10, let's say 10 and under, you're getting a great deal. 11 to say 15 or 16, you're getting a fair value. Anything above maybe 18 and up, it's considered expensive. So at $23, so McDonald's with a PE ratio of about 23, it'd be a little expensive. So people might say, you know what, I will buy, but I like to wait for the price to drop. And you'll do your math, and you say, okay, it may have, how much does it have to drop before I dive in? Maybe it gets to $225. I'm just giving you these broad strokes for you to get a framework, okay? So 10 and less, great value. Maybe you say 11 to 16 or so, fair value. And then above, 17 and up, you'd say you are getting in the expensive territory. Okay, so this is the PE ratio, and that's how you evaluate company A versus company B, right? Because one company might be $400 per share, but the PE ratio might be 12. That's a great discount, right? Another company, it may be only $50 per share, but the PE ratio may be 24. So that is kind of expensive, okay? If you're getting value, make sure to give me a subscription, send this video. If this is content your family or friends could benefit from. Okay, so we're building a portfolio, right? We're building a portfolio. And obviously, we have a limited amount of cash, so we want to spend our cash very judiciously. And one of the things you want to know is PE ratio. Okay, let's go. Another thing you want to consider is how long has this company been paying dividend, right? If this is a new jack and they just got on the scene, there's really no history to say, are they going to be able to continue to pay the dividend? But that's why dig in and doing your research, you'll be able to look into the earnings, look into the net income, look into the EPS or the earnings per share, and really get a feel like, okay, you know what? They have plenty of cash. Their earnings per share is affordable. It's a good deal. The payout ratio is very low, so there's room to grow the dividend, and there's also room for the company to keep back some money and room for the company to grow as well. But there's some established companies that have been paying dividends for a long time. Some have been paying dividends for over 50 years, part of the S&P 500. They call them dividend kings, and there are companies called like dividend aristocrats, part of the S&P 500 that's been paying dividends for 25 years. So again, the established companies out there, when you begin to start digging in and doing your research, you can begin to add them as you're building your portfolio, right? There's a lot of information out there, so we don't have to reinvent the wheel. I didn't mention dividend yield, which is very important, but we had mentioned that in the previous video, part one. So if you want to go into more details on dividend yield, check out part one. But essentially, dividend yield is basically the amount of dividends the company is paying you divided by the share price. So if the company is paying you $5 per year, and most companies pay 4 times a year, so $1.25 per quarter, total of $5 per year, and the share price is $100, it'll be $5 divided by $100, the share price, and that's dividend yield will be 5%. I didn't mention that because even though it is important, I mentioned it in part one. Okay, so what else you may want to know when you're building your portfolio? Another thing you want to know is dividend growth, right? Because yes, McDonald's is paying $1.52 per quarter in 2023. And when you look into the history, how much were they paying before? And how much do they anticipate they're going to be paid next year, right? So that's called the dividend growth. A lot of times you see CAGR, which is compounded annual growth rate, CAGR. So you may say this company has a dividend CAGR of 8%. Because every year they grow the dividend, it'll be a different amount, right? Some company may grow 1 year, they may grow the dividend year over year 4%. The next year they may grow the dividend 8%. The next year over year, they may grow 5%. So they may aggregate certain time period, 5 years or 3 years or 10 years, and say the dividend compounded annual growth rate over the last 5 years has been 8%. Meaning it hasn't been 8% every year, but when you add up all the dividend growth over that time period and divide it by the X amount of number of years, it gives you that number. So people would like a high compound annual dividend growth rate. Essentially, they want their dividend to be growing at a nice clip, right? You definitely want to beat inflation. So if inflation is 2%, obviously we know it's been higher lately, but if it's been 2%, you want your dividend growth rate to be maybe 5, 6, 7, 8%. That's how you grow your dividend. Okay? So let's quickly review these things to consider when building your dividend stock portfolio. One, is the company making money? So you want to look at the profitability. So you're going to look at the 10Q or the 10K, which is go into Google and go into the investor relations page of your company. And then you'll see the earnings, right? And then you'll see how they're doing year over year or quarter over quarter. So is this company making money? So is it profitable? Okay, so you go into the 10Q and 10K. Number two, dividend yield. We said very important, right? Because we did a video before, but dividend yield is very important. Okay. Number three, you want to look at the dividend payout. How much are they paying out? And number four, the dividend payout ratio, right? Is it too high that it's not going to be sustainable? Number five, how expensive is the stock? How do we know? We look at something called the PE ratio, or the price to earnings ratio, or the price to earnings multiple. We said 10 and less is a good deal. Maybe 11 to like 16 would be fair value. 17 and up, it's beginning to get more expensive. That's how you can compare stock A to stock B. Number six, how long have they been paying dividends? Right? They've been paying dividends for a long time. Maybe they're a company that they value the shareholder and they want to reward them for being shareholders. If they just started, you never know what's going to happen. Have there been any dividend cuts, right? Any dividend suspension? You want to look at that too. And especially look at the years where there's economic turmoil. So 2008, 2020, Did they cut their dividend? Okay. And number 7, dividend growth. Because you want your dividends to grow to beat inflation, right? Because if the company is giving you the same amount every year, we know that the buying power is going to be less. Again, guys, this is the MD Investor trying to increase our financial IQ so we can teach our children and finally break the cycle of generational poverty. If there's people in your circle who could benefit from this type of content, send them the link, tell them to subscribe on YouTube. And until next time, continue to command your money to grow. MD Investor out.